Hi there, my name's Neil Dickey. Welcome to this pensions technical video where we're taking a look at alternative ways of achieving clients' objectives other than by transferring. The FCA's guidance on assessing the suitability of a defined benefit pension transfer makes it clear that advisors should consider alternative ways of meeting the client's objectives, while retaining the various benefits that they enjoy through their ongoing membership of their defined benefit scheme. This requirement is also stated in the FCA's Conduct of Business Sourcebook section 19.1.6. An alternative way of meeting the client's objectives won't always be possible. Where alternatives can be used, though, the FCA want to see them thoroughly discussed with the client. Some of the more commonplace objectives that could possibly be met by other means are greater flexibility of income and capital, better provision of benefits on death, and repayment of debts. And we'll now consider each of these in turn, starting with greater flexibility of income and capital. This is an often stated objective for clients considering a pension transfer. Defined benefit schemes are very inflexible in terms of paying retirement benefits, with the scheme pension only varying in as much as it increases every year in payment, and the main capital flexibility being the choice of the amount of the tax-free lump sum at the point of retirement. Increased flexibility can mean different things to different people, and not everyone requires total flexibility, with many people being happy with a more limited amount of flexibility. Having established the extent of the flexibility required, it's important to establish whether this could be provided by utilising the client's other pension and non-pension assets. Other pension assets. Where the client, or their partner or spouse, has other defined contribution pensions, these could potentially be used by way of drawdown to provide the degree of income or capital flexibility that the client requires. With regards to other non-pension assets, where the client has non-pension assets available to them, income and capital withdrawals could be varied from these assets as required by the client. Looking now at better provision of benefits on death. For many clients, considering transferring out of their defined benefit scheme, a key consideration is the provision of benefits on death. Transferring can provide a greater ability to leave pension monies to family members on death, the options or ability for which may be limited under the existing DB scheme. For example, they may have concerns that their spouse will have a reduced income after they die, or because they have financial dependents who would not qualify to receive anything in the event of their death. Further, they may feel that their spouse and children will not benefit from the full value of the pension when they die, because there is either no lump sum death benefit payable at all, or only a very limited amount, such as a return of contributions or a small multiple of their pension. It may, however, be possible for the client to remain in their defined benefit scheme while at the same time achieving their objective regarding better provision of death benefits. They could take out a whole of life plan with a sum assured equal to the value of the death benefits that they wish to provide their beneficiaries. This should be written under trust for the intended beneficiaries to speed up payment and keep it outside of their estate for inheritance tax. Of course, the viability of this option will depend on the state of health of the client and the availability of cover at an acceptable and affordable ongoing cost. If the cost is prohibitive, a term assurance policy up until the age they plan to take benefits could be an option, though this would not improve the death benefit position if the client was to die once beyond that age. It's also worthwhile establishing what existing life cover the client already has and whether this could be regarded as helping meet this objective. Where the client wishes to leave a legacy for their children, it may be that once the overall value of their estate is calculated, that they then come to the conclusion that they have sufficiently met this objective in this regard without needing to take into account any death benefit resulting from a pension transfer. Moving on now to repayment of debts. Another common objective for a client considering transferring out of a defined benefit scheme is to repay any outstanding secured or unsecured debts. This could be because they're struggling to make their monthly payments, or because they have an interest-only mortgage in place and no means of repayment, or because they do not wish the debt to continue on into retirement. It may also be that they are simply tempted by the potential availability of a lump sum, and it's an easy way to clear their debts. There may, however, be other ways available to them of clearing their debts, or at least making them more manageable. When considering the available options, it's important to establish the reason for the debt, where it was not used to purchase a property. As if it is a result of poor financial discipline, the likelihood is that the problem will simply occur again in the future. Rather than transferring out of their defined benefit scheme and releasing capital to clear their debts, it is important to consider other alternatives. This could be by way of restructuring the debt. This could involve looking for lower interest rate options for credit cards, or switching a mortgage onto a better deal, or possibly even extending its term. Of course, this will depend on the client's credit rating and the availability of credit. Making overpayments. This approach, which will clear the outstanding debt sooner, could work for credit cards or possibly mortgages, if the terms permit, but it is unlikely to be available for fixed-term loans. Using other assets to repay the debt. Subject to there not being any early repayment charges, or at least ones the client is willing to pay, the client could use other capital to clear the debt. When doing so, however, the opportunity cost of using the capital would have to be borne in mind. In other words, the potential return that is foregone when using the capital for debt repayment instead. Thank you for watching.